The federal government of Nigeria and the World Bank have reportedly agreed to cancel about $707.7 million in undisbursed funding meant for Nigeria's power sector recovery program. The decision has generated major reactions across the country because many Nigerians expected the loan to help improve electricity supply, reduce blackouts, and strengthen the power sector. According to reports, the cancelled funds were part of a larger $1.52 billion power sector recovery program originally designed to reform Nigeria's electricity industry. The program aimed to improve electricity generation and distribution, strengthen the financial stability of power companies, reduce government subsidy pressure, and support long-term energy reforms. The program initially showed some progress after it was launched in 2020. Reports indicated that tariff shortfalls reduced significantly between 2019 and 2022. However, things became more difficult after the naira depreciation and the foreign exchange liberalization policy introduced in 2023. Gas prices for electricity generation increased sharply, while electricity tariffs for many consumers remained largely unchanged. As a result, the financial gap in the power sector widened massively. Government subsidy obligations reportedly jumped from around N$140 billion in 2022 to nearly N$1.9 trillion annually in 2024 and 2025. This created serious pressure on both the government and electricity companies. Reports further revealed that only a small portion of the additional financing approved in 2023 was actually disbursed. The World Bank reportedly classified the implementation performance as moderately unsatisfactory because many reform targets were not achieved. Following these challenges, the Nigerian government formally requested the cancellation of the remaining undisbursed balance in March 2026. Both parties then agreed to discontinue the program earlier than planned. The project's closing date was moved forward from June 30, 2027 to May 31, 2026. Many analysts believe this cancellation highlights the deep structural problems facing Nigeria's electricity sector. Despite years of reforms, the country still struggles with poor electricity generation, weak transmission infrastructure, inadequate metering, rising debts, and unstable power supply. Millions of Nigerians continue to rely on generators and alternative energy sources due to frequent blackouts. Some economic experts argue that the cancellation may help Nigeria avoid accumulating additional debt on funds that were not being effectively utilized. Others, however, fear it could slow down important electricity reforms and reduce investor confidence in the sector. The development has also reignited national conversations about government borrowing, economic reforms, subsidy removal, and transparency in project implementation. While Nigeria has recently cleared some international debts such as the IMF emergency loan, the country still maintains several external loan obligations with institutions including the World Bank and the African Development Bank. For many Nigerians, the biggest concern remains simple. Despite billions of dollars invested in the power sector over the years, stable electricity is still unavailable in many parts of the country. The cancellation of this major World Bank power loan has therefore raised fresh questions about accountability, policy consistency, and the future of Nigeria's electricity reforms.